Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze Amazon stock. Specifically, I'm going to talk about whether Amazon stock is still a buy now or whether it's better to wait. Before I start, I always like to give you more context first. At the time of making this video, Amazon's market cap is just slightly below 2 trillion. Amazon stock has recovered a lot from the large dip from 2 months ago. However, Amazon is still not near its all-time high yet, even though the entire market has recovered a lot recently. There are several headwinds affecting Amazon right now. First of all, just like Google, Meta, and Microsoft, Amazon is planning to increase its spending on AI infrastructure in the upcoming quarters. Of course, many investors are not happy about this because Amazon's capex will be higher while its margins will likely be lower in the upcoming quarters. Second, the antitrust regulators are targeting all the big tech companies, including Amazon, with dominant market shares. For example, the Federal Trade Commission (FTC) claims that Amazon has been using anti-competitive behaviors and tactics to prevent third-party sellers from offering lower prices outside of Amazon stores. Also, the FTC is claiming that third-party sellers are forced to use Amazon's logistics services if sellers want their products on Amazon Prime. Here's the interesting part you may not know. The antitrust regulators are targeting all the mega cap tech companies, including Apple, Google, Microsoft, Meta, and Amazon, because these regulators believe that these mega cap tech companies are using anti-competitive tactics to maintain their near monopolies. In fact, these antitrust regulators want to break up all the big tech companies' businesses. This is why most of the big techs, including Amazon, have not fully recovered yet, even though the S&P 500 is near an all-time high. I always say this in all my videos. The best time to invest in a great company is when there's a lot of fear in the market or when the market is overreacting to any short-term headwinds. The stock is likely undervalued when the market is very fearful. And of course, the worst time to invest is when the market is extremely greedy because the stock is likely overvalued. So in this video, I'm going to explain whether Amazon is still a great company for long-term investing. I will talk about whether Amazon stock is fairly valued, undervalued, or overvalued now. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about Amazon's biggest risks to consider, Amazon's financial review, Amazon's long-term growth prospects, Amazon stock valuation, and whether I will buy Amazon stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term. Follow my personal stock portfolios and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. At the time of making this video, the S&P 500 is near another all-time high. The market is very greedy again and is very close to extreme greed. This means many stocks are likely overvalued now. Typically, I like to keep investing in the best companies only when they are undervalued or when there's a large dip in the S&P 500 and Nasdaq 100. I don't like to trade stocks. Instead, I like to buy and hold the best stocks for the long term so their businesses can grow much more over time and eventually become multi-bagger stocks. Let me give you a quick update on one of my stock portfolios. This portfolio is separated into 3 different accounts. This is the first account. You can see I have invested in MasterCard, Microsoft, Visa, TSMC, Amazon, Google, Meta, and SML. All of them are the market leaders in their industries. In fact, all of them are near monopolies. This is my long-term investing strategy. This strategy has worked very well for me over the years. I like to keep investing in the best businesses that have very large economic moats, great products and services, great management teams, great long-term prospects, increasing earnings, and increasing free cash flows over time. I like to keep buying them only when they are below their intrinsic values. Then I just hold them for the long term, so they can grow much more over time. This way, I don't even need to trade stocks. I just keep buying and holding the best businesses for the long term while going through all the market cycles. This is the second account. This is the same story as the first account. I have invested in Apple, Google, Visa, TSMC, Microsoft, Nvidia, and Amazon. They are the best businesses in their industries. They are near monopolies. It is nearly impossible for competitors to compete with them because their platforms, their ecosystems, and their products and services are already very well entrenched in their markets. This is the third account. This account is much newer than the two other accounts, so it will take longer for these companies to become multi-bagger stocks. The investing strategy is the same here. You can see I have invested in TSMC, Nvidia, Meta, AMD, Microsoft, ServiceNow, Amazon, Google, Broadcom, Visa, Synopsys, SML, and Intuit Inc. All of them are the market leaders in their industries. Most of them are near monopolies. Going forward, I expect all these outstanding companies will continue earning higher revenues, higher earnings, and higher free cash flows over time. I expect that most of them will become multi-bagger stocks. So instead of trading them, I plan to buy and hold most of them for the long term. Let's go back to Amazon. What are the biggest risks we should consider? The biggest risk is these antitrust cases against Amazon. I believe this is a short-term headwind. The US FTC alleged that Amazon is using anti-competitive behaviors to prevent third-party sellers from offering lower prices outside of Amazon stores. Also, the FTC is claiming that Amazon is using its dominant position in e-commerce to force third-party sellers to use Amazon's fulfillment services or force sellers to invest in Amazon ads. This is from the Wall Street Journal. It explains some of FTC's allegations against Amazon. The federal agency and the states alleged that Amazon violated antitrust laws by using anti-discounting measures that punished merchants for offering lower prices elsewhere. The government also said sellers on Amazon were compelled to use its logistics service if they want their goods to appear in Amazon Prime. The subscription program whose perks include faster shipping times. Such time, the complaint says, illegally restricts sellers' choices and reduces product selection available to Amazon's rivals. The FTC also says sellers feel they must use Amazon services, such as advertising, to be successful on the platform. This is the important part. It explains that the FTC has a very poor track record of bringing antitrust cases against companies. Until recently, it has been rare for federal agencies to file monopoly lawsuits seeking to break up companies accused of anti-competitive behavior. While the FTC and Justice Department regularly seek to block what they see as illegal acquisitions, the government doesn't often move to break up companies for anti-competitive behavior unrelated to acquisitions. The FTC doesn't have a particularly good history of bringing monopolization cases. This is from the Seattle Times. The FTC and 17 state attorneys general sued Amazon in September 2023, arguing the company unfairly used its position as an e-commerce superstore and fulfillment network provider to keep its rivals from gaining a foothold. In the sprawling lawsuit, the FTC accused Amazon of promoting its own brand over competitors, preventing third-party sellers from setting discounted prices and forcing merchants to pay steep fees to Amazon itself. For consumers, that meant higher prices, fewer options, and a degraded shopping experience. I'm going to be very blunt here. I believe most of FTC's claims are completely wrong. First of all, the FTC has been very anti-business toward the big techs in recent years. The FTC is not only targeting Amazon, the FTC is targeting all the big tech companies including Apple, Google, Amazon, Microsoft, and Meta, which have dominant positions in their markets. The FTC wants to break up big tech companies' businesses, not just Amazon's, because it believes they are using anti-competitive tactics to maintain their near monopolies. If you think about these antitrust cases, most of them do not make sense at all. The FTC and the other antitrust regulators are punishing the big techs, including Amazon, because they are too successful and dominant in their markets. Here's another thing we have to consider. There's a tech war between the US and China. It's also an AI arms race or a chip war between the US and China. This tech war will last for many years. Both the US and China are competing to become the dominant leader in AI, chip design, advanced chip manufacturing, cloud computing, high-performance computing, and the most important technologies. I've said this several times in my previous videos. It's in the US best interest to make sure US companies, especially the big techs, continue innovating and being the market leaders in AI, advanced chip design, high-performance computing, cloud computing, mobile computing, and other leading-edge tech. This means it does not make sense for the antitrust regulators to break up Amazon's businesses. Typically, the antitrust regulators do not break up large companies that already have dominant positions in their markets. Instead, the antitrust regulators tend to block these large companies such as Amazon from acquiring other companies that would greatly reduce competition in the market. Similar to Google and other big tech companies, I believe the most likely scenario is that Amazon may need to pay large fines if the antitrust regulators find that Amazon has been using anti-competitive behaviors to maintain its near monopoly in e-commerce and other services. The antitrust regulators will not break up Amazon's businesses because the US wants Amazon and other big tech companies to continue innovating and becoming market leaders in the most important technologies. In terms of competition, Amazon can argue that the company is facing a lot of competition from Temu, Shein, and other online discount stores from China. For example, Amazon can argue that sellers can choose to sell their items at cheaper prices on Temu and Shein if sellers think that they are paying too many fees when they sell on Amazon. Typically, if you want to buy cheaper products online, you can buy the same products or similar products from Temu, Shein, and AliExpress instead of Amazon. The biggest downside is that it takes much longer for Temu, Shein, and AliExpress to ship their products from China to international customers. One of Amazon's biggest competitive advantage is that its delivery service is very fast and much more reliable. Typically, if you're a Prime member in North America, Amazon can often ship products to you within the same day or 1 day or 2 days. And if you're not happy with the product, you can often ask Amazon to refund you the entire purchase very quickly. In comparison, if you buy from the Chinese discount stores, they can often take 1 week to several weeks to ship their products from China to your home. I believe this is why most customers like to shop on Amazon, even if Amazon products do not have the best pricing compared to Temu and other online discount stores from China. This is also one of Amazon's biggest competitive advantage. Here is another headwind that is impacting Amazon now. I believe this is a short-term headwind. Many investors are concerned that Amazon is overspending on AI infrastructure, which would likely impact Amazon's operating margin and free cash flow margin in the upcoming quarters. As of now, all the big techs are racing to build their AI infrastructure and spending billions on NVIDIA's AI GPUs and AI supercomputers each year. The main reason is that they do not want to be left behind in the current AI arms race. The risk of underinvesting in AI is much higher than the risk of overinvesting in AI. In any technological breakthrough, once you're behind, it's very hard to catch up to the market leader. So it's much better for Amazon to overspend on AI infrastructure now and build up the capacity to meet customers' AI demand. Let me show you these financials. Over the past 10 years, Amazon has had very consistent revenue growth, operating income growth, free cash flow growth in most years, and increasing operating margin in most years. In the upcoming quarters, Amazon is planning to increase its AI spending to stay competitive in the current AI arms race. This means Amazon's operating margin and free cash flow margin will likely decrease slightly in the upcoming quarters. Amazon's operating margin and free cash flow margin tend to be very low in the single digits because Amazon's businesses are very capital intensive. It's extremely expensive to build Amazon's warehouses, fulfillment centers, and fast delivery services around the world. Amazon has to invest billions in its fulfillment centers and delivery network each year. Amazon's cloud computing business, AWS, is also very capital intensive. Amazon has to continue investing billions in IT infrastructure and data centers each year in order to stay well ahead of Microsoft Azure, Google Cloud Platform, and Oracle. The positive side is that it's extremely hard for new competitors to compete with Amazon in e-commerce and cloud computing because it's very capital intensive to build these businesses. Let's take a look at Amazon's most recent balance sheet. I believe Amazon has a very strong balance sheet. In the most recent quarter, Amazon had around 89 billion in cash equivalents and marketable securities. In comparison, Amazon had around 133 billion in long-term debt and long-term lease liabilities. Amazon generates more than 40 billion in free cash flow each year. Amazon will not have a problem paying off all this long-term debt and lease liabilities while investing billions in its businesses each year. Let's talk about Amazon's financials and long-term growth prospects so you can understand its biggest growth opportunities moving forward. When I analyze Amazon, I like to analyze Amazon's businesses separately. Amazon has 6 major businesses: online stores, physical stores, third-party seller services, advertising services, subscription services, and Amazon Web Services or AWS. Amazon's online stores and third-party seller services have been Amazon's biggest revenue contributors for many years already. However, Amazon's online store business is very mature. Amazon's online store business has been growing at single-digit rates for many quarters already. In comparison, Amazon's third-party seller services have been growing much faster than its online store business for many quarters already because Amazon has been offering many more products from third-party sellers than its own products in recent years. In terms of profits, Amazon's advertising services and AWS have been contributing the most profits for Amazon for many years already. This will continue to be the trend in the future. Every quarter, Amazon shows its revenues in these 3 major segments: North America, International, and AWS. As you may already know, most of Amazon's operating income is from Amazon's AWS, followed by Amazon's North America business. For example, AWS contributed about 64% of the total operating income in the most recent quarter. In comparison, North America business contributed about 35% of the total operating income. Amazon's international business used to lose a lot of money every quarter. Now, Amazon's international business has started generating positive operating income in the last 2 quarters. This is a good indicator showing that Amazon's international business will become more profitable going forward. This will help increase Amazon's overall operating margin. I expect that Amazon's total revenue will continue to grow over time because Amazon has one of the most product selections, excellent refund policies, excellent customer service, and the fastest delivery services, especially for Prime members, compared to other competitors. In North America, most customers tend to shop on Amazon first before shopping at Walmart, eBay, or other online discount stores from China because Amazon has the best refund policies, the fastest delivery services compared to competitors, and many benefits for Prime members. It's very hard for competitors to compete with Amazon's fulfillment centers and fast delivery services because it's very capital intensive to build them. Only very few companies have the capital to build these warehouses, fulfillment centers, and fast delivery services. I said this earlier, Amazon is facing a lot more competition from Temu, Shein, and other online discount stores from China. Amazon is planning to release a new online discount store that will ship products directly from warehouses in China to customers. This means delivery will take much longer than before. However, customers who want to buy cheaper products will be willing to wait for their products to ship from China to their homes. In terms of outlook, for the next quarter, Amazon's guidance is slightly lower than Wall Street's expectations. For example, for the next quarter, Amazon's management expects that the company's total revenue will be between 154 billion and 158.5 billion. This is slightly lower than the analyst's forecast of 158.43 billion. In addition, management expects that the company's operating income will be between 11.5 billion and 15 billion. Again, this is slightly lower than Wall Street analysts' forecast of 15.2 billion. Let me show you this consensus revenue and EPS forecast. Instead of focusing on Amazon's quarterly growth, I believe it's much more important to focus on Amazon's long-term growth over the next several years. Over the longer term, Amazon's revenue is expected to grow between 10% and 12% each year over the next several years. In comparison, Amazon's EPS is expected to grow at much higher double-digit growth rates over the next several years because Amazon's operating expenses will likely grow slower than its revenue growth over the next several years. Let's take a look at Amazon's two most important profit drivers, advertising and AWS. Both advertising and AWS will continue to drive the most profits for Amazon for many years because these two businesses have much higher growth rates and because they are much more profitable than Amazon's e-commerce business. You may not know this, Amazon's advertising business has already become the third largest digital advertiser in the US, just behind Google and Meta. Amazon is already earning more ad revenues than Microsoft. Going forward, third-party sellers will continue to spend a lot of money on Amazon ads because Amazon is the most popular online retailer in the US and in many other countries. More importantly, Amazon has the most users searching for things to buy, so it makes sense that third-party sellers will continue selling their products on Amazon and investing in Amazon ads. In addition to advertising, AWS will continue to be Amazon's most important business and the biggest profit driver for many years. There are several reasons. First, the cloud computing market is dominated by three hyperscale cloud providers: Amazon AWS, Microsoft Azure, and Google Cloud Platform. These three hyperscale cloud providers have dominated the cloud market for many years. For example, if you combine their market shares, they account for around 70% of the cloud infrastructure service market, which includes infrastructure as a service or IaaS, platform as a service or PaaS, and hosted private cloud. Amazon has been the market leader in the cloud infrastructure service market for many years. It has maintained over 30% of the market. Here's the important part you should know. Cloud customers tend to be very sticky. For example, once you start investing in AWS cloud services, it's very hard and costly to switch to Microsoft Azure, Google Cloud, or Oracle. This is why Amazon has been able to maintain over 30% of the cloud infrastructure service market. Second, the barriers to entry in the cloud infrastructure service market are extremely high. It costs billions of dollars to build data centers around the world. Cloud companies such as Amazon, Microsoft, Google, and Oracle need to invest billions of dollars in IT infrastructure and data centers each year in order to stay competitive in the cloud market. This is why I believe Amazon will continue to be the market leader in the cloud infrastructure service market for many years. Third, even without the large demand for generative AI, large enterprises and government agencies around the world will continue migrating their IT workloads from on-premises infrastructure to the cloud. This is because cloud computing is much more scalable and flexible than traditional on-premises IT infrastructure. I believe this secular trend will continue to benefit Amazon AWS for many years to come. And fourth, the large demand for training and inferencing AI models, along with building the best foundation models, will continue to drive more revenue for AWS and other hyperscale cloud providers. For example, if you want to build a large language model, LLM, or a foundation model, you will need to invest hundreds of millions in AI GPUs from NVIDIA or AMD. Realistically, not many AI companies can afford such an investment, so most AI companies need to rent AI GPUs from cloud companies such as AWS, Microsoft Azure, Google Cloud, or Oracle. Let me show you this forecast from IDC. According to IDC, worldwide spending on public cloud services is expected to double between 2024 and 2028, growing from $805 billion in 2024. This represents a compound annual growth rate CAGR of 19.4% between 2024 and 2028. Goldman Sachs published a similar forecast. Goldman Sachs expects that cloud revenues will reach $2 trillion by 2030. This is higher than IDC's forecast. Goldman Sachs expects that generative AI should account for about 10% to 15% of cloud spending. The total addressable market for cloud services is poised to expand at a 22% compound annual growth rate from 2024 to 2030. Here's the important part. According to a recent survey by Goldman Sachs, only about 30% of workloads have moved to the cloud. This suggests that Amazon AWS will still have a lot of growth opportunities going forward because many companies have not moved their IT workloads to the cloud yet. Also, more companies will need to invest in AI to stay competitive. Otherwise, they will be left behind by other companies that use AI to increase productivity, increase sales, and improve products and services. I want to share the most important parts of the recent earnings call with you. Management talks about AWS growth rates, higher capex in the upcoming quarters, and the importance of investing in AI to stay competitive. Management said this.
Moving next to our AWS segment, revenue is $26.3 billion, an increase of 18.8% year over year, excluding the impact of foreign exchange. AWS now has an annualized revenue run rate of more than $105 billion. During the second quarter, we saw continued growth across both generative AI and non-generative AI workloads. We saw companies turn their attention to newer initiatives, bring more workloads to the cloud, restart or accelerate existing migrations from on-premises to the cloud, and tap into the power of generative AI. Now let's turn our attention to capital investments. As a reminder, we define these as a combination of CapEx plus equipment finance leases. For the first half of the year, CapEx was $30.5 billion. Looking ahead to the rest of 2024, we expect capital investments to be higher in the second half of the year. The majority of the spend will be to support the growing need for AWS infrastructure as we continue to see strong demand in both generative AI and our non-generative AI workloads.
Here's the important part. It shows the demand for AI will remain very strong in the upcoming quarters. Management mentioned that customers have been signaling a need for much more AI capacity from AWS going forward. This is why Amazon is spending a lot of money on AI infrastructure.
So most companies deliver more capacity than they need. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income. And I think you can tell from having, we disclose both our revenue and our operating income in AWS that we've learned over time to manage this reasonably well. And we have built models over a long period of time that are algorithmic and sophisticated that land the right amount of capacity. And we've done the same thing on the AI side. Now, AI is newer, and it's true that people take down clumps of capacity in AI that are different sometimes. But it's also true that it's not like a company shows up to do a training cluster asking for a few 100,000 chips, the same day. Like you have a very significant advanced signal when you have customers that want to take down a lot of capacity. So while the models are more fluid, it's also true that we've built, I think, a lot of muscle and skill over time in building these capacity signals and models. And we also are getting a lot of signal from customers and what they need. I think that it's, the reality right now is that while we're investing a significant amount in the AI space and in infrastructure, we would like to have more capacity than we already have today. We have a lot of demand right now, and I think it's going to be a very, very large business for us. I think the generative AI component is in its very early days. It's as I said, we kind of sometimes look at it and say that's interesting that we have a multi-billion-dollar revenue run rate already in AI, and it's so early. But if we look at the amount of demand that we have from customers right now, it's very significant. So I think all three of those things have a chance and will likely continue over time, and we'll see where that growth rate nets out over the next number of years. I think that one other thing I would say about that too, Mark, is that the business today, as I mentioned, it's a $105 billion revenue run rate business. About 90% of the global IT spend is still on premises. And if you believe that equation is going to flip, which I do, there's a lot of growth ahead of us in AWS as the leader in all those dimensions I mentioned. But I also think that generative AI itself and AI as a whole, it's going to be really large. It is not something that we originally factored when we were thinking about how large AWS could be. And unlike the non-AI space, where you're basically taking all of this infrastructure that's been built on premises over a long period of time and working with customers to help them migrate it to the cloud, which is a lot of work, by the way, In the generative AI space, it's going to get big fast, and it's largely all going to be built from the get-go in the cloud, which allows the opportunity for those businesses to continue to grow.
Let's talk about Amazon's valuation, so you will know whether Amazon stock is likely undervalued, fairly valued, or overvalued now. At the time of making this video, Amazon's forward PE is expected to be around 39, which is a bit high. By next year, Amazon's forward PE is expected to drop to around 32, which is much more reasonable. Right now, I'm developing an application with a partner. This screenshot is a preview. This orange line represents Amazon's fair value, and the blue line is Amazon's stock price. Ideally, the best time to invest in Amazon is when the stock is well below the fair value line, so there will be a higher margin of safety. At the time of making this video, Amazon is still slightly below the orange fair value line. I believe this suggests that Amazon is still slightly undervalued. Let me show you this intrinsic valuation model. Instead of using a DCF model, I'm using a simplified sum of the parts valuation model to calculate Amazon's intrinsic value. You can use it to calculate Amazon's intrinsic value, so you will know when Amazon stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. I have separated Amazon into these 5 major business segments: Amazon's online stores and third-party seller services, Amazon's physical stores, Amazon's subscription services, Amazon's advertising services, and of course, AWS. They match Amazon's business segments, which I showed you earlier. I'm using these comparable companies to calculate the average price to sales PS ratio for each business segment. Then I calculate each business fair intrinsic value before adding all of them together. Let's go over each business segment. First, Amazon's online stores and third-party seller services trailing 12 months revenue is around $387 billion. I'm using Walmart and eBay as comparable companies. The average PS ratio is around 1.83. Then Amazon's online stores and third-party seller services should be worth around $707 billion. Second, Amazon's physical stores trailing 12 months revenue is around $21 billion. I'm using Costco and Kroger as comparable companies. The average PS ratio is around 0.61. Then Amazon's physical stores business should be worth around $13 billion. Third, Amazon's subscription services trailing 12 months revenue is around $42 billion. I'm using Netflix and Spotify as comparable companies. The average PS ratio is around 4.84. Then Amazon's subscription business should be worth around $204 billion. Fourth, Amazon's advertising services trailing 12 months revenue is around $51 billion. I'm using Google and Meta as comparable companies. The average PS ratio is around 6.19. Then Amazon's advertising business should be worth around $318 billion. Fifth, AWS trailing 12 months revenue is around $99 billion. I'm using Microsoft and Oracle as comparable companies. The average PS ratio is around 7.86. Then AWS should be worth around $774 billion. If I add all these businesses together, Amazon's intrinsic value for the entire company should be around $1.97 trillion, or around $184 per share. I also used a forward sales valuation model to calculate Amazon's intrinsic value, which should be around $2 trillion for the entire company, or around $190 per share. If we calculate the average of both valuation models, I believe Amazon's intrinsic value should be around $187 per share. In comparison, Morningstar has given Amazon a slightly higher fair value of $195 per share. This means I believe Amazon is likely fairly valued or still slightly undervalued now. So will I buy Amazon stock? Yes, I will continue buying more Amazon shares over time as long as Amazon is still undervalued. There are several reasons. First, I believe Amazon will continue dominating the e-commerce market, especially in the US, even if it faces more competition from Temu and other online discount stores from China. Second, I believe Amazon will become much more profitable over time because of its advertising business and AWS, which are much more profitable and are growing much faster than its e-commerce business. Third, I believe AWS will continue growing at double-digit growth rates each year because more companies and government agencies will continue migrating their IT workloads to the cloud. Also, the current AI revolution will continue driving more businesses to AWS because AI companies need to rent AI compute from AWS to develop their LLMs or the next frontier AI models. Similar to Google and other big tech companies, I believe the antitrust cases against Amazon are just short-term headwinds. Amazon is already facing more competition from online discount stores from China. The US wants to be the leader in AI, cloud computing, and other leading-edge tech, so it will not make sense for the US regulators to break up Amazon's businesses. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.